Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you today.
Nice to see you as well. Hey, I want to have a crazy conversation. I want to talk about just an out of left field what if. And this is because earlier in the year, people can go back and watch on your playlist. We were talking about rates getting in the sixes, causing housing slow down, correction, all of that stuff. Well, they did. They got to I think the peak was 6.13. I could be wrong, but I'm close. Then they've backed up. Here recently, they've been under 5%. I want to play just a crazy what if game with you. Let's assume Wall Street is white, inflation is peaked, it's going to come crashing down, recession goes from second priority to first priority, and the Fed starts cutting rates or pausing or whatever they're going to do. And the 30-year mortgage rate, I don't know, pick a month, November, December, all of a sudden, Greg, doesn't have a 6 on it. It has a 3 on it. What do you think happens to housing if we back up in rates and suddenly people can get a 3 on their 30-year mortgage again? Does housing just take off? Do we plateau? What do you think's going on?
I think, obviously the market will stay heated. You'll see more demand, more competition again for houses, but I think it'll be a little bit more tame given the economic environment because inflation is still a problem. So, I mean, in your question, did you say inflation's fixed, recession, all that we're just back to normal, or what do
No,
you?
basically what I'm painting here, the way we get to 3%, and again, I want to be clear, I'm not calling for it. I just
Right,
want to
right. We're
play a
just
what if
we're
game.
just
Yeah. So,
hypothesizing.
so in this case, the Wall Street's right. Inflation is not a problem. So it's no longer 9.1. Let's call it 3%. I'm just making stuff
Yeah,
up now.
inflation's done. There's no recession.
No,
Rates
but no,
low.
I think again, this is just hypothetical. I think inflation's 3%. Let's call unemployment 5%. So it's up from 3.5 to 5. Not crazy, but higher than today. And we're at the tail end of a recession, right? GDP shrinking, I don't know, 1% a quarter. So it's not a gangbuster economy. We're in a recession, maybe the tail end. Because I think that's the only way we can get, a 3% mortgage. So that's the picture. I think that maybe we have a 3% on
Yeah, so I
the
think
30.
what happens then is your buyer's affordability index comes back into line a little bit more, so you have more buyers. So right now,
Yeah.
people are just priced out of the market. So prices stay elevated, demand increases, you get competition again, multiple bids, and people's affordability comes back up. So it'll continue, and we haven't seen a big enough correction yet, really, because there's still so much demand out there. Now, certain markets obviously are correcting well above others. And there's other markets where, I mean, there's just such a lack of availability of inventory all the way around, even before the resale market pressures started with those interest rates. But I mean, when you think about it, 2.5% interest is, that's what really drove this train and,
Yeah.
drove the values to where they were. Question is, will we ever get back to that again? That's interesting because if you think about where we are now, if we're peaking at 5 or 6, whereas in the past we would peak at 9 or 10.
Right.
So if you think about, adjustments in terms of the liquidity cycles and the business cycles in the market, what if we revisit 2.5% again at some point?
Yeah, let's play it. I mean, again, I'm not calling for any of this and certainly not calling for this year, but let's just play the game. Let's say, in order to get to 2.5%, let's say, so inflation's done. We've got inflation under 2%. I think that's the only way we get to a 2.5 on the 30-year mortgage. We probably have a deep recession. So unemployment's probably not 5. It's probably 7. It's not double digits, but it's up there. And the economy has probably shrunk 4 quarters in a row, but still, I think to your point, even at 7% unemployment, we still have 93% employed. We probably have, I think one thing that I think would happen in that environment is some states would win and some would lose, right? I think what we've seen is Texas, Tennessee, Florida have had a lot of migration, a lot of employers. I think that continues. I think those markets stay hot, especially with a 30-year mortgage at 2.5. And then the expensive states like New York and California keep losing, just population wise. So I think it is, I think it's wild to think about. I don't think it could happen this year, but shoot, maybe next year. I don't know.
Yeah, it's really interesting. And when you think about what triggered all these events, going back to the pandemic, when the housing stock contracted because people just shut their houses down, they didn't want to have people
Yeah.
coming in. You had increased pressure on construction trades. We've had a problem in the trades industry getting enough people to build enough units. I think right now there's a deficit of about 4 to 5 million units in the country right now that we need, housing units to fill demand and to keep pace with what's needed right now. But you think about the whole trickle down effect of starting with the pandemic and inventory coming off the market, and then the jobs situation, the great resignation happening where people can work from home, they don't need to move, and employers now hire remote workers, and that becoming more of a thing. So you have less necessity to sell on behalf of a lot of people. And then you have record low interest rates and people refinancing and locking those rates in, creating even less, urgency and necessity to sell. And you think about now, and then the supply chain issues, putting more pressure and extending the amount of time it takes to deliver new homes to the market. There's a lot of things that need to correct to ever be able to catch up and create inventory levels that are healthy again. It's just, man, it's interesting.
Yeah, the other thing I was just thinking about, I've come to believe, and hopefully will be quoted in some magazines eventually, that with the phrase that the Fed broke housing, right? They kept rates too low for too long. We have supply lock-in, now we have demand destruction with higher rates. But if we revisit 2.5, the housing markets, I think it starts humming again. Something I just thought about is right now the move-up market is dead, right? I'm a first-time homeowner. I bought my home. My wife's pregnant. I'm just going to buy bunk beds. Screw it. Kids sleep together, right? Same room. But if you get back to 2.5, suddenly it's all back on the table. Okay, honey, let's sell our first home. Let's move up, better school district, extra bedroom. Oh, you know what? Let's get an extra bedroom plus a den or an office, because now we're doing Zoom meetings and we're going to the office one day a week. And oh, by the way, we don't have to live in California or New York anymore in a shoebox. Let's go somewhere else and get, a bigger, newer house. I think if mortgage rates get to 3, it doesn't even have to get to 2.5. Let's say mortgage rates, the 30-year mortgage gets to 3%, Greg. I think the move-up market starts humming, because again, you could sell and buy, and you're only paying a little bit more. What do you think of that?
Yeah, it's all relative. Yeah, so with the values where they went relative to the rates where they went, it was all a wash. So prices were just through the roof, but rates were so low it didn't matter.
Didn't matter. Yep.
Yeah. So that's what'll happen. It'd be a wash, and again, the inventory level is the issue, and there'll be huge demand, lines out the door again, multiple offers, and a lot of people will be priced out of the market and just will be unsuccessful. So I think a lot of people are just burned. They're just tired of it. You see it over and over and over. They've just checked out of the housing market. Rates are still up. So I think we're going to continue to see correction. But yeah, if rates drop down to 3% or less, you just see it all over again. The question is, can we bring more inventory as the supply chain opens up, as people get back to work and things like that, and people get laid off, maybe they enter the construction trades. And that's really your issue, is there just aren't enough people out there to build houses right now to be able to deliver enough units.
Yeah, I think transactions explode higher, because I think, especially, let's just say 2.5 or 3% mortgage rate happened in 2024. So it's like a year and a half out. I think transactions explode again, because again, the Fed broke housing, 2 years of artificially low rates. We have 2 years of move-up market not going anywhere. We have all this pent-up sales, because again, the move-up market is important because it's 2 transactions. I sell my first home and I buy another one. That's not happening today.
We get anybody move up, move down. Every buyer, every seller is a buyer, every buyer is a seller. So pretty much you have some that transition into long-term rentals at the end of the road, whether senior living or just rentals, like my mom just did. Sold her house a couple of years ago and moved into an apartment townhouse, to kind of live out the rest of her days. But the other thing, when you think about it, going back to 2008 and 9, I mean, we had a ton of labor. We were able to build as many houses as we wanted.
Yeah, labor was not the problem.
Yeah. So you just can't do that now, and it's really interesting where we are in this market with housing. It's just everything. I mean, it's just really an interesting time.
Yeah. Do you ever, when in your broken crystal ball, total guess, do you see any time in the next decade where we could actually have a 30-year mortgage rate with a 2 on it again? Or is that just a one-off pandemic, shut the economy down thing?
You think about what it took to get there, and it was really bond rates that, it was a risk on environment, bond rates. So yeah, I mean, potentially once we get through this, if the Fed pivots and starts QE all over again and drops rates all over again, then yeah, you're going to see the money flow out of the bond market, because that's what you got to remember. Mortgage rates are based off of loosely, they're not tied like directly, but loosely tied to the 10-year treasury. So that's risk on, risk off. So when the Fed is in an accommodative environment, with flooding the market with all this money, dropping interest rates, so you could borrow money at almost nothing to buy stocks and, grow your company and do whatever. That's when the money floods out of the bond market into the equities. Because you got to remember, no matter what the market is doing, no matter whether you're in recession, depression, contraction, expansion, it doesn't matter. There's allocators out there. So you have life insurance companies, investment funds, sovereign wealth funds. They have to allocate. They have to put capital to work because they got to pay these premiums, and pension funds, those types of things. So that's where that comes from. That's where the big money comes from that moves these rates, comes in and out of the bond market. And that's what we saw recently, is the money flooding back into the bond market. That's why rates are dropping, because everybody's flooding back in there. And it's just interesting times. So I think that's what it would take. It'd take the Fed pivoting, driving rates back down, and it would take another, it would take a serious situation to reinvent what we just had. But we just went through it, so it could happen again.
Yeah, look in the rearview mirror. It happened. It happened once. It could happen again. I think.
And then it's all relative. I mean, think about cars. Cars are kind of the same example, where there's no reason a Suburban should be $100,000, or a pickup truck should be $70,000. I mean, it's ridiculous. It's because of the financing. If you think about it, you could only get 3-year loans.
Yeah, I remember.
Or 4-year loans, and you had, you had to pay interest. Then zero interest became a thing, and then 5 years, 6 years, 7 years. Before you know it, there's going to be an 8-year loan on a vehicle. So, it's all about the payment.
I agree. All about the payment. Greg, do me a favor. Where can people find you?
Yeah, GregDickerson.com. That's where my info is. Go check it out.
Awesome. Thanks, buddy.